Hi, so welcome back to Feanut Financial Model online course. In this video, we will start going through the model and we will start with the Data Inputs Worksheet, specifically with the Main Inputs Worksheet where some initial data modeling assumptions are populated. So I will just click on this button and that will get me to Main Inputs Data Worksheet. So in this worksheet we have a couple of tables with the required basic modeling inputs. So we will use our example of pen factory throughout this online course. So let's start populating some of these tables. So let's start with basic inputs. What we populate in here is name of our company. So our company is called Pen Factory Incorporated. And you probably noticed that there are different colors for these cells and that they are changing. That's something that we talked about in a previous video. So this light yellow color of the background of the cell indicates that it is a cell where certain data input should be populated. If the cell is highlighted in orange, that means that this is a required data input. You will see later in the worksheet that some of the inputs can be omitted. So if it is a data input cell for data input that is not required or that can be omitted, then even if it is blank like this, it will be highlighted in yellow. But if it is a required input, it will be highlighted in orange, and it will remain orange until you provide a data input, and once you provide a data input, the color of the cell will change to yellow. So this dynamic color coding also helps you to understand where do you have to provide the data that is required for the model. And the model will just highlight those cells for you, so you can immediately tell that if the cell is orange, you know that you should populate some data into that cell, and once you populate the data, it will turn into yellow. So let me just retype the name of the company in here. So Pen Factory Incorporated. The next data input, the basic input, is the modeling date or the start date of the model. So Feanut Financial Model actually prepares the projections for a 5-year period, which is a very common modeling period for business plans and financial models. So you populate the start date in here. Let's say for us that will be 1st of January 2016, and then the model starts from this date and models the financial plan for the years 2016, 17, 18, 19, and 2020. You probably noticed that our financial model for this example starts at the beginning of the calendar year. The model actually has a functionality that allows you to use financial year that does not equal the calendar year. In that case, you have to indicate that in the next field. So in our case, our modeling or financial year equals calendar year. So I've selected yes in here. But in case, for example, that for whatever reason my starting date will be, let's say, 1st of May 2016, then my financial year does not correspond with my calendar year. Therefore, I have to switch it to financial year in here. So I'll select no, and now the model knows that my financial year starts at the 1st of May. And it will reflect that in all the other modeling tables. If you will not change this indicator to no, if I will return back and select yes in here, then in this case the model will start from the 1st May 2016, but it will still think that the calendar year equals the financial year. So for the first period, for the year 2016, it will take into account only the period from May to December, and then for the last modeled year, it will take only 4 months from January until April. So we will not have comparable periods because the first modeling period will only cover 8 months and the last one will only cover 4 months. Therefore, we have this switch in here, and when you switch that to no, so even if your start date is not the 1st of January, the model will understand that your financial year does not equal calendar year and will adjust all the calculations appropriately. But let me return back to my original scenario. So we start the 1st of January 2016, my calendar year equals my financial year. Now for currency, I can type in the 3-letter currency code. So let's say I'll be using US dollars in this example. In fact, this is only used for the presentation purposes. So when I go, for example, into the income statement, this field here that says that all the numbers are in US dollars, that's populated based on what you select in the main menu here. Or if I go to, for example, charts, here it says that it's in thousands of dollars, which is my next selection in here. So for presentation purposes, for charts and for the summary, the executive summary worksheet, I can select whether the numbers should be presented either in thousands or in millions. So both of these selections are only for the presentation of data, where there are some automated text in here that says, see, now I switched it to millions, so all the charts automatically switched to million USD. If I will change my currency to euro, for example, again, I go back to financial statements, for example, now it says it's in euro. The charts are also in millions of euro. But let's just go back to US dollars and thousands. Now the next table that we have here is data table for tax modeling inputs. So for corporate tax rate, just populate whatever the corporate tax rate is effective in your country. So we will use 25%. There is an option in the model when calculating the corporate income tax of carrying any tax losses to future period to be offset against future profits. This is actually a typical tax legislation, typical tax option in many countries. So you can select yes in here, and if your business will be loss-making, for example, in first year or first couple of years, then it will allow to offset that loss against the profits in future year for the purposes of calculation the corporate income tax. However, if you are not sure about whether this option is available in your country or not, just select no in here. And the last thing in here is the month in which the corporate income tax is typically paid. This can vary country from country. In some countries you actually may pay the income tax more often than once a year. You may pay it on a quarterly basis, but for the purpose of our model, we assume that the corporate income tax is paid once a year, and you can select the month of the year in which this is paid, and it is used for the modeling of cash flows. The next table we have in here is for cash and revolver modeling. Cash and revolver is a section of the model that has impact on balance sheet as well as on your cash flow statement, and it models the way how the model deals with month-on-month fluctuations in the level of cash that you have in your company. The companies very often use so-called revolving credit facilities that are provided by banks. So you have a short-term revolving loan from a bank that has a certain limit, and you can withdraw from that loan to cover your short-term fluctuations and variability of your cash flows. In our model, you can select the limit for this revolving credit facility to be either floating or fixed. So you can actually switch in here and select between those two. If you select fixed, then the model will highlight for you the cell that you should use to provide the maximum limit of this so-called revolving credit facility that the bank will provide to you. So let's say that this will be, let's say, $250,000. Or I should actually type a negative amount in here because it's a credit line. So let's say it will be $250,000. And that means that if in certain period, in certain month, I will need more money that I actually have in my cash balance, I can use this short-term loan up to this limit. But sometimes this limit is actually set as a floating limit. What that means is that the bank does not set a fixed limit for these short-term borrowings, but instead these are calculated as a percentage of some liquid assets that the company has. This is typically a level of trade receivables or trade receivables plus inventory. In our model, we are using trade receivables plus inventory, and if you select the floating option in here, then you will just populate in here the percentage of liquid assets that will be used as a limit for a revolving credit facility. Sometimes this percentage is 100%, sometimes it's 90%, or something between 80% and 100%. For our example, let's use 80% as the limit. So in our example, we will use the floating revolving credit facility limit of 80% of liquid. assets. The next thing that you can populate in here is the interest rate. And you can populate the interest rate that you will pay on any negative balance of your revolver credit facility and any interest rate on the positive cash balance on your bank account. So for interest rate on revolver, let's use 5%. Interest rate on cash deposits, and these days this will be a very small amount. Let's use 0.5%. In our case, it could be even less than that, but let's use 0.5% for our example. Next thing that you can model or that you can use in the model is a limit on minimum required cash. Sometimes the companies require certain amount of cash to be in your bank account all the time, and the model allows you to model this. Again, you can select whether this limit will be modeled as floating or as fixed. If you select floating, that means this limit will be set dynamically based on the percentage of revenue. So we can say that, for example, we would like to have 1% of the revenues as a cash balance that we will keep in our bank account all the time. And this limit will change from period to period because our revenues will be changing. Or we can decide that we want to have a fixed limit, and then we can populate some number in here, let's say 50,000. And now the model will always keep $50,000 in our bank account. What that means is that, for example, if in a certain month the financing need or the need for cash to finance salaries, to finance inventory, to repay debt, and so on and so on, will go below 50,000, the model will automatically draw money from revolving credit facility. So whenever it falls below 50,000, it will go to revolving credit facility and take money from that facility instead of taking money from the cash balance that we have in bank accounts. So this is sometimes used in the models if you would like to set a required amount of cash that you would like to keep as a reserve in your bank account all the time. Of course, you can set this to 0. If you don't want that, you can set this to 0. For our example, we will actually use floating 1%. You can also switch off the revolving credit facility limit. Some businesses, and this could be the case for some startups, may not get this revolving credit facility or may not have access to this credit facility from the bank. So in case you would like to switch that off, you just set the limit to 0, either 0% limit, or if you use fixed, you'll just set 0 for the fixed limit. Let me switch that back to 80%, for example, that we will work with. The last one, the last table that we have in here, some valuation inputs. These are some specific inputs for the valuation, so-called sub-model that we have in our financial model. All you have to populate in here is the weighted average cost of capital or your benchmark for required return on investment, and this will be used in the valuation model to discount the free cash flows. The valuation model that we use in here is based on discounted cash flow approach, and I will speak about that specifically in another video. But for now, just remember that the assumption that you should populate in here should be your required return on investment. So let's say we will use 10% in here. And the second one is long-term growth rate. This is another parameter used in discounted cash flow valuations, because the way this valuation approach works is that it is split into two parts. The first one is the value of the business for the period that we specifically model. So that's these 5 years that we model specifically. But your company will continue to exist even beyond this period. It will exist for another 10 years or 30 years or maybe 100 years. And the discounted cash flow models model this period beyond this initial modeled period that is modeled specifically. It uses this long-term growth rate, which is like an annual growth rate at which the company will continue to grow indefinitely. A benchmark for this growth rate that you can select is, or could be, something close to annual rate of inflation, because you cannot expect that over the long term your company will grow at the same rates at which it may grow, like in the first years of your startup business, where the growth rates can be quite significant on an annual basis. But in the long term, what you can expect is that you will grow at the rate of inflation, or maybe something above the rate of inflation. You should not expect that the company or any business could continue to grow, for example, at 10% a year indefinitely. So for our example, let's use 3%. And I will talk about this valuation submodel in a later video where we will go through the details. So for now, these are all the main inputs that we need to populate in this main input worksheet. So you can give it a try with your versions of the model if you purchased it. And in the next video we will continue with the sales inputs, so populating the tables for your assumptions on your sales.